In 2023, Carlos Tavares pulled in $39.5 million running Stellantis, which works out to 518 times what the average worker at his company earned that same year. 12 months later, he was out, and the company he left behind posted a $22.3 billion loss, the largest annual loss by any major automaker in recent memory. If you own a Jeep, a Ram, a Dodge, a Chrysler, or any vehicle built by this company, that number is not just a headline. It is a direct threat to your resale value, your warranty support, your parts availability, and the dealer network you count on for service. I am going to show you exactly how the fourth largest car company on Earth went from record profits to financial collapse in 12 months, what it means for millions of American car owners right now, and what you should do about it before you buy, sell, or trade in anything with a Stellantis badge on it. Three numbers tell this entire story. In 2023, Stellantis reported $18.6 billion in net profit, the best year in the company's history and an all-time record. By 2024, that figure collapsed 70%, landing at $5.5 billion, which means $13 billion in profit vanished in a single year. And in 2025, the company did not just lose money, it lost $22.3 billion. And that is not a typo, that is $22 billion with a B. Stellantis sits behind 14 car brands you already know. If you drive a Jeep Grand Cherokee, a Ram 1500, a Dodge Charger, or a Chrysler Pacifica, you are a Stellantis customer, whether you realized it or not. And the same goes for Fiat, Alfa Romeo, Maserati, Peugeot, Citroën, and Opel overseas. The company came together in January 2021 when Fiat Chrysler merged with the French automaker PSA Group in a $50 billion deal, the biggest auto merger in history at the time. The idea behind it was straightforward. Combine an American-Italian company that sold trucks and SUVs with a French company that dominated European small cars, then share parts, share factories, cut costs, and print money. For 2 years, that formula worked, and the profits poured in. By March 2024, the stock touched an all-time high near $27 on the Milan exchange. And that is when everything fell apart. Here is what you need to understand about how this happened. The collapse did not start with some freak event or a sudden market crash. It started with decisions made at the very top that squeezed short-term profit out of the products you buy, and the people running your local dealerships tried to warn the company before it was too late. The dollar amounts alone are bad enough, but they are not even the worst part. When you see what actually happened to the American brands, to the trucks and SUVs that millions of you drive every day, it will change how you think about your next car purchase. In the third quarter of 2024, total Stellantis sales in the United States dropped 20%, but the damage to individual brands was far worse. Chrysler cratered 47%, Dodge fell 43%, and Ram slid 19%, with every single brand trending down. Across the full year of 2024, Stellantis moved 1.3 million vehicles in the US, a 15% decline, and in 2025, that number slipped again to 1.26 million. Over 5 years, the company shed close to 5 percentage points of US market share, and no major automaker in the country lost ground faster. The problem came down to two things. Stellantis jacked up prices on trucks and SUVs to squeeze maximum profit per vehicle, and that strategy is what powered those record 2023 numbers. But here's the thing. It also priced out buyers. Vehicles piled up on dealer lots, and US dealer inventory ballooned past 400,000 units, which is wildly above a healthy 60-day supply. Dealerships were drowning in trucks that nobody would buy at those prices. At the same time, the product pipeline dried up. The Ram 1500 transition ran late, and the new Dodge Charger launched as an electric-only vehicle called the Daytona to a lukewarm reception at best. Ram CEO Tim Kuniskis admitted that the company, quote, dropped the ball on getting lower-priced Ram 1500 trucks to market. And when you look at Chrysler, the picture gets even bleaker. Chrysler now runs as a one-model brand built entirely around the Pacifica minivan, and that is the whole lineup from a company that once built the 300, the Town & Country, and the PT Cruiser. What this means for you is direct and personal. If you own a Ram, a Jeep, or a Dodge right now, the resale value of your vehicle rides on the health of the brand behind it. When a manufacturer falls into crisis, dealer networks thin out, parts get harder to source, and buyers grow nervous about purchasing used models from a company in trouble. That pattern plays out every single time a manufacturer stumbles, and it is playing out right now. And this is where it gets worse. Your local dealerships saw this coming and tried to stop it. In May 2024, the chairman of the Stellantis U.S. National Dealer Council, Kevin Farish, sent an open letter directly to CEO Carlos Tavares. That council represents roughly 2,600 dealerships across the country, the same people who sell you the car, service your car, and honor your warranty. Farish accused Tavares of, quote, reckless short-term decision-making that was causing, quote, rapid degradation of Jeep, Dodge, Ram, and Chrysler. Let that register for a moment. The company's own dealer network publicly labeled the CEO reckless, and in the car business, that almost never happens. Dealers depend on the manufacturer for inventory, for marketing support, and for warranty reimbursement, which means going public like that is the nuclear option. By September, the dealers fired off a second letter, and at that point, Stellantis stock had already dropped about 40% for the year. None of that was happening in isolation. UAW President Shawn Fain called Tavares, quote, a terrible CEO that has no business running this company, and the union was threatening strikes over broken promises to reopen the Belvidere assembly plant in Illinois. The dealers were revolting, the union was revolting, and the stock was in free fall. And that is when Stellantis delivered the September 30th, 2024 profit warning, cutting its margin forecast roughly in half, and the stock dropped another 15% that single day, wiping about $6 billion off the company's value in one trading session. Now, if you are sitting there thinking the CEO got fired and the problem is solved, let me show you why that is not how this played out. Tavares did not get fired. He resigned on December 1, 2024, citing what Stellantis described as different views from the board, and he simply walked away. No permanent replacement arrived for 6 months. His total 2024 compensation package, covering salary and severance, came to $35.1 million, and shareholders approved it with 67% of the vote. The man who oversaw a 70% profit collapse, who was publicly called reckless by his own dealers and terrible by the largest auto union in America, collected $35 million on his way out. During that same stretch, roughly 1,100 workers at the Vauxhall plant in Luton, England, lost their jobs when that factory shut down for good. That contrast tells you everything about how this company operated under his watch. Here is the part most people get wrong about that $22.3 billion loss. Stellantis did not suddenly sell $22 billion fewer dollars worth of cars, because revenue in 2025 actually dipped only about 2% from the prior year. The real damage came from a colossal write-down, $25.4 billion in what the company labeled unusual charges, and the bulk of that number, roughly $14.7 billion, traced back to one strategic miscalculation. Stellantis bet everything on electric vehicles, and the bet did not pay off. Under Tavares, the plan called for an aggressive electric push across the entire brand lineup, building battery factories, launching dozens of EVs, and racing to lead the energy transition. The problem was that customers did not show up, at least not at the pace Stellantis predicted. When the 2025 results landed, new CEO Antonio Filosa put it bluntly, quote, "Our full-year results reflect the cost of overestimating the pace of the energy transition. What followed was billions written off in canceled EV products, billions more in battery platform impairments, and billions in scrapped development programs. Battery gigafactory plans, including a joint venture facility in Termoli, Italy, were frozen, and the Italian government clawed back roughly $200 to $300 million in EU funding that had been earmarked for that project. Here is the number that puts the whole mess in perspective. By mid-2026, the company's entire market value sat at roughly $16 to $17 billion, which means Stellantis wrote off more money than the whole company is currently worth on the stock market. You might assume the European brands were holding steady while the American side bled out, but the numbers tell a different story. Fiat, the company's largest brand globally, watched European sales drop about 20% in 2024 and slide another 11% in 2025. The Fiat 500e electric car sold so poorly that the Mirafiori factory in Turin, the historic birthplace of Fiat, shut down repeatedly, including a full closure from December 2024 through early January 2025. And then there is Maserati. And this is the one that should stop you cold. In 2017, Maserati moved over 51,000 cars worldwide, but by 2025, that number had collapsed to 7,900, an 85% decline. Porsche, which competes in a similar luxury space, moved over 279,000 cars that same year. And to put the gap in plain terms, Porsche sold more vehicles in roughly 10 days than Maserati sold in the entire year. Revenue at Maserati fell to $726 million, and the brand is running a negative 27% operating margin, which means it is burning cash with no bottom in sight. That is the full picture. Record profits turned into a $22.3 billion loss. The American brands gutted, the CEO gone, with $35 million in his pocket, and the stock down roughly 75 to 80% from its peak. Here is what actually matters to you right now. If you currently own a Jeep, Ram, Dodge, or Chrysler, do not panic, but do pay close attention. At the end of 2024, Stellantis still carried about $49.5 billion in available cash and credit, which means this company is not filing for bankruptcy tomorrow. The brand you drive is weaker today than it was 2 years ago, though, and that affects you in concrete ways. Here is exactly what I would do in your position. Check your warranty coverage today, not next week, today. Know exactly what is covered and when it expires. If your powertrain warranty runs out in the next 6 months, seriously weigh whether an extended warranty directly from Stellantis and not a third-party plan makes sense for your vehicle. During a corporate crisis, the first things that get cut are the things customers do not notice right away, like dealer staffing, parts inventory, and service turnaround times. Warranty coverage gives you bargaining power when those cuts start to bite. If you are thinking about selling or trading in a Stellantis vehicle, move sooner rather than later. Resale values follow brand perception, and the headlines surrounding this company are not improving anytime soon. The new CEO's turnaround plan does not project positive cash flow until 2027, and that is a long stretch for your vehicle's value to erode while the market waits to see whether the company actually recovers. If you are buying in 2026 and looking at a Jeep, a Ram, or a Dodge, use this situation to your advantage. Dealers are sitting on inventory, and they know the headlines just as well as you do, which means you hold negotiating power you did not have 2 years ago. Do not pay sticker price. Walk in knowing the dealer needs to move metal and that Stellantis is pushing incentives to clear lots. Get competing quotes from at least 3 dealerships, and do not let anyone tell you the vehicle is scarce, because the inventory numbers say the opposite. One more thing before we wrap up. If someone tries to pitch you a Maserati or an Alfa Romeo as a smart buy because the price is low, be very careful. A cheap luxury car from a struggling brand is not a bargain. It is a maintenance risk attached to uncertain parts support. New Maserati Levante and Quattroporte launches have been pushed to 2027 and 2028, and that is a brand running on fumes with no new product to stop the bleeding. Go back to where we started, with Carlos Tavares, the man who pulled in $39.5 million in 2023, earning 518 times what his average worker took home that year. He left behind a company that just posted the largest loss in its history, a company whose own dealers called his leadership reckless, and a company now scrambling to undo his electric vehicle strategy by committing $60 billion over 5 years in a turnaround plan called Fast Lane 2030, just to claw back to break even. New CEO Antonio Filosa, a 25-year company veteran, has already scaled back the profit targets and publicly acknowledged that 6 to 8% margins count as reasonable, after Tavares chased 10% and above. Filosa has scrapped the all-electric plan and shifted to what the company calls multi-energy, meaning hybrids, plug-in hybrids, and gas engines running alongside EVs. Whether that plan succeeds is an open question, and the company itself warns not to expect meaningful profitability or positive cash flow before 2027. Shareholder lawsuits are active, the stock still trades near all-time lows, and the American brands face a long, hard climb back. What I know for certain is this: 14 car brands and hundreds of thousands of jobs ride on whether this turnaround works, and millions of American car owners are living with the consequences of decisions they had absolutely no say in. The best thing you can do is make your next move with your eyes wide open. Know the facts, know what your vehicle is worth today, and not what you hope it will be worth next year. And if you are buying, walk into that dealership knowing the power has shifted in your direction. Use it. If this kept you from making a costly mistake, you know what to do.